Good morning and welcome back to Sugar Mama's Fireplay, the podcast where we ignite your financial independence, fuel your early retirement goals and dreams, and help you build long-term sustainable wealth. Today, I am joined by someone very special to me and this community. That is my own personal mortgage broker, Adam McCabe from Blue Lantern Home Loans. Now, if you have been following the news, and you may have actually seen my segment on Channel 9's The Today Show, you would have heard about the changes to the first home guarantee. That is the government's 5% deposit scheme that has just launched. Now, this program has been designed to help make home ownership more accessible by removing the need for the 20% deposit that traditionally we needed. And more value of this is actually avoiding costly lenders' mortgage insurance, which can easily hit into the thousands, if not tens of thousands for some. So this is really interesting, this new scheme. But here's the thing. There is so much fine print behind this, and there are so many details that not everyone actually understands yet because this is only just launched, and including a very interesting rule that actually may allow people who haven't owned property for 10 years, even though they may have owned previously, such as, say, single parents, to actually qualify. Now, my ears really pricked up when I went through the fine print, trying to find as much information as possible, because this then means it isn't actually just limited to first home buyers, but it actually can include people, as I said, like single parents or people who've maybe previously owned many, many years ago, in excess of 10, because they may actually qualify for this and not have to pay lenders' mortgage insurance and secure a property for their family, create that stability and security with as little as 5%. So in today's episode, I'm actually going to pick Adam's brain about this because obviously he knows in more detail as to how it works, who qualifies, and what the actual process looks like, even how he can help you, and obviously how to prepare for this, because you don't actually have to just stop at 5%. You can keep saving as much as you like and still make the most of this government guarantee. And I also want to flag, whilst there are obviously issues behind this, you've also got to keep in mind that you need to pay this mortgage off and help maintain a life of a decent quality of life and obviously your own lifestyle. So, all right, enough from me. Let's break down everything that you need to know and understand about the newly launched First Home Guarantee Scheme with Adam McCabe. Good morning, Adam. How are you?
I'm great, Kenna. How are you?
I'm well, thank you. I'm well.
Excellent.
I wanted to say to everyone listening right now, Adam is an amazing resource. He's someone who I use personally, and also he's helped out a lot of my family members and friends. So if you ever want to ask Adam, you don't have to go through me. You can just go directly to Adam, and I'll obviously link his contact details in the podcast notes. But Adam, this is quite exciting, this first home guarantee. I will admit there are obviously some issues behind it, concerns, but how does this work from a logistical, practical point of view?
Well, the basics up front are that the government are essentially replacing the mortgage insurer. And with replacing the mortgage insurer, you then save on mortgage insurance. So you're not paying any premium to cover not having the 20% deposit.
On average, how much would someone save by not having to pay mortgage lenders insurance? I know it's obviously subject to the size of the loan and obviously the deposit that person actually has. But I mean, are we talking a $2,000 saving or like an $8,000 saving from this?
Well, it's a step. The LMI premiums are stepped. So the higher your loan to value ratio and then the higher the loan amount, that premium will increase. But at the top level, in Sydney, the new price cap is 1.5 million. So if you buy at that 1.5 million and you've only got the 5% deposit, you would save $55,000 in mortgage insurance.
$55,000 in mortgage insurance from this. Wow.
Huge.
Okay. That is huge, because I mean that's a couple of years worth of savings.
Well, it's almost another 5%.
Yeah, gosh. Okay, this is important. Who can actually apply for this?
So it's open to all citizens and permanent residents. You've obviously got to be an adult, so minimum of 18. Prior to October 1, there were price caps and income caps.
Have they been scrapped though, haven't they?
They've been scrapped.
Which
So
is great.
the price caps have been increased, but the income caps have been removed altogether. So it's open to everyone that can qualify and buy in those capped amounts.
And this is for people buying a principal place of residence. You can't be buying this to then rent the property out.
That's correct. You can't use it for investment purposes. It's to reside in. There can be different types of property. So you can buy vacant land and build. That's okay. Or completed properties, but it has to be for occupation, owner-occupiers, not for investors.
What happens, though, for someone who does this and then 3 years later then decides to rent that property out? I mean, I know we don't have the rules yet about this because it's obviously not looking forward 3 years' time, but does this person mean that they are locked in to only live in that property and if they have to then sell it? Or am I asking a question that's too unknown right now?
A bit too unknown, but at the same time, I think if you think about it rationally, right, like so previous first home buyer grants and first home buyer benefits, you had to move into the property, even if for 6 months, within the first 12 months, I think it was. So once you qualify and you meet that policy or that rule, I think you're okay because no one can force you to live in something, at a later date. If your circumstances change and you can't afford it anymore.
Yeah. And you think, I'll rent it out.
Yeah, you've got to make a change for the family. Absolutely. I would think that would be okay. There's common sense approaches to that.
Yeah. But obviously you need to check the fine print when once the government obviously becomes a lot clearer as to where the boundaries are. All right. Can we talk about people who qualify for this that haven't bought a property for 10 years? Because I went on the Today Show and I said this and I was really scared in saying this, but I did a lot of research and everywhere I checked, I was right. But nobody else is talking about this. And that is, it's not just first homeowners. It's people who haven't owned a property or bought a property for at least 10 years. They potentially qualify for this from what I read on the government website. So if I'm wrong, we can blame the government for incorrect or misleading people. But no one else is talking about this. I felt like I stuck my head out and was quite risky. And I did have a moment of panic going,
well, that's right.
Did I go cross-eyed?
No, you're right. So if you haven't owned property for more than 10 years, you qualify as well. But you can't own one currently, obviously.
Yes, because that would mean you're a
there are whether you still own an investment property is probably more what I mean.
Oh, that's the grey area.
Yeah.
Okay.
So there's still some clarity we need to understand around that, but it's a little bit murky. The rules are that you have to not have owned a property for 10 years prior to the day that you sign the loan contract with your lender.
And that's why it's so important to work with a mortgage broker who can actually ask those questions, tick those boxes and make sure everything is bulletproof and you are safe in qualifying.
Look, I think it complicates things. It should just be that you can't sign a purchase contract prior to that 10-year date. That would make it simpler because there could be some grey areas there where you sign a purchase contract, then you have to wait a certain period of time to reach that 10 years if it's not far away.
Yeah.
But then you've got the pressure on to meet settlement by the due date. But
anyway,
that's what a good mortgage broker will navigate that for you.
This is huge. So as I sort of in the introduction, this means single parents, particularly in cities like Sydney where, the rents are being put up or people are selling their property or they're moving back into their property and, young families don't have that sense of stability and particularly, single parents. This is an opportunity if you have a deposit or you're working on saving a deposit to be actually able to qualify for this and, potentially save, $50,000 in lender's mortgage insurance through this if you haven't owned a property for 10 years. This is massive. Why aren't more people talking about this very important group of people?
It's obviously designed to help those who have owned previously, run into trouble, financial difficulty, or maybe family troubles that can now get back into the market.
They need to change the name to not just First Home Guarantee. It needs to be First Home and
within 10 years.
Within 10 years previously owned. Yeah. All right. I really want to make people aware of that because I think everyone knows at least one person that's a single parent that hasn't owned, for 10 years and would desperately love to create a sense of stability and security for their family. And not just parents, but, individuals as well. All right. Can we move on to the actual deposit needed and how much money you have to have saved? Because it doesn't just stop at that 5% deposit, does it?
No. So you need a 5% deposit, which needs to be genuine savings. It can't be a gift.
Okay. What does genuine savings look like? What is the definition?
Definition can vary from lender to lender, but it's generally 3 months minimum, but in many cases it might be 6. So in many cases it might be 6 months to verify that you've held that minimum amount for that period of time. That's to show the bank certainty that you can either save for an extended period or maintain having that deposit without dipping into it regularly. You can dip into your savings regularly, that's okay, but 5% as a minimum needs to be saved. It can't be gifted and it can't be a loan.
So you should be able to show those savings transactions.
Yeah, it's showing good behaviour and pattern.
like healthy financial habits.
Correct, yeah.
And the bank can see that you're going to be able to service a mortgage, handle interest rate rises, and actually eventually pay it off in due course.
Correct. And it's obviously the government part of the scheme is to not just hand it out to anyone who's, wealthy background who can just be handed money as their deposit. Show some restraint and good behaviour to maintain that, and then you can apply for the loan.
What about beyond the deposit? It's not just 5%.
No.
What other expenses have we got to account for here?
That's where it gets tricky, and that's where you need a good broker and some good legal advice to navigate that, because from state to state it varies. So there's the stamp duty concession, but stamp duty in New South Wales only covers you up to $800,000. From $800,000 to $1 million, it's then concessional stamp duty, so it's discounted. But anything above $1 million, you're paying stamp duty as well.
Yeah.
Legal fees, so conveyancing fees, removalist costs, insurance, they come with everything, and they're reasonably insignificant fees. But the big one is the stamp duty if you don't qualify for the exemptions.
And things like building inspections, strata searches, and things like that. All those intricacies of when just as you're about to buy. So you're not just stopping short of the 5%. You've got to keep going. Your additional expenses you've got to factor in.
That's where it's a bit sneaky, the wording. It's not if 5% just doesn't get you in the door.
Yeah.
And then obviously I like to tell all of my clients, when you're buying a home and you're then taking out a mortgage, you want to have some cover. I like to say minimum 3 months of mortgage repayments as a buffer, so that if you do run into some trouble, you'll be okay to get by until a new job comes along, or whatever that out-of-pocket expense that was unexpected is dealt with, that you're still okay. So you don't want to just have 5%, throw it all in, you've got nothing left.
Yeah.
You want to have a bit of backup.
And, I always say to people, whilst you're going through that settlement period, say a 6-week settlement period, keep saving your little heart out, so that you have that buffer building up as quickly as possible, even if you have had to just clear your bank accounts out. Can we talk about the property caps and how it impacts in different locations? Because this is not a one sweeping general rule. No.
So as you'd expect, Sydney's got the biggest cap, which is 1.5. So there used to be there are also regional caps as well. So 1.5 is metro, and then there's regional caps, which are now 800,000.
Okay. So you look that up on a map and you can see the boundaries?
No, so there's a postcode tool. So you plug it within the First Home Guarantee website. There's a postcode tool where you can plug in that postcode. It will tell you which section that qualifies under. So then you've got Victoria and Queensland as well have got a higher metro cap and a higher regional cap as well. So Victoria's gone to 950 from 800, and then their regional has maintained at 650. And the regional ones, I guess, are the ones that have less expansion over the last few years, whereas the metros is where it's really going a bit crazy and the higher cap is needed. Where can you buy in Sydney for, the previous cap was 900?
Yeah.
That's very hard.
A car spot.
Yeah.
All right. Even with the government guarantee, what conditions are the lenders that you work with obviously every day? And I know there's a lot of them, but what are they looking at? Like serviceability, sensitivity around interest rate rises?
All the same applies. We still need to apply responsible lending. So you've got 3% buffer on the servicing assessment of your borrowing capacity. Still the same verification of income. The savings is the big one, the genuine savings, as well as any existing commitments that you've got. So repayment history on car loans or credit cards. Nothing really changes in that respect. It's still got to be responsible lending.
And you have to go through a particular lender, don't you? You can't just go to any old random bank.
You don't have to, but it's a good point. Some lenders are not participating in the government scheme.
Really?
Yeah. So, for example, ANZ isn't in there.
Wow.
Yeah. I don't think that's a bad thing. I think that's a good thing. I think one really good foundation of the banking system in Australia is that we've got really good competition. And through that competition, there are so many banks and mortgage providers now have understood that we need to have niches. Because if every bank provides the same, you're going to have people miss out. So separate banks having different niches just opens avenues for customers that their existing lender may not meet. So some lenders not participating in this isn't necessarily a bad thing. We still need to have banks that focus on other niches.
Okay, so what are now the hidden costs or the pitfalls or even risks of this?
Same as what would apply with any mortgage. I mean, although the one difference, which applies to anyone who are borrowing 95%, even if you've been an existing homeowner, well, you can't have certainty around income because that can change, correct. But stability, because the last thing you want to do is go and buy a home where you've only kicked in 5%. So the bank owns 95%. And in 6 to 12 months' time, you've got to hand the keys back. Or if
the market comes back
and you can't afford the loan, they take possession. So you want to have some stability before just thinking, hey, great, I've got 5%, I'm going to go and buy. So understand how your employment situation looks. As we said earlier, a buffer.
Yeah.
You want to have something to fall back on, because we can never plan for the unexpected.
And things like obviously having income protection, personal insurances in place to add that additional layer of protection.
Definitely.
And even peace of mind. If someone's listening to this right now and is like, okay, I think I might qualify. Like, what are the steps involved? Obviously, start saving minimum of 3 months worth of regular saving habits that can be demonstrated through transactions and deposits and so forth, and leaving that money within reason. What else do we need to be doing? When do we pick up the phone and call a mortgage broker like yourself? When do we start looking at property? What are the sensible, smart steps involved to make the most of this opportunity whilst it's red hot?
I'd say the most important step is understanding what your capacity is. And your capacity firstly starts with your income and your ability to repay. So what loan repayment can you afford? And then that dictates your loan size, that dictates your purchase price. So,
and that's something you can tell people?
Absolutely. We do that every week.
Okay.
You don't necessarily need to have the 5% up and ready to go. If you're partway through or you just started the journey, it's okay to check in with a broker to understand what your capacity might be based on your income, so that you can set yourself a target goal of what you need to save to then.
I think that would be invaluable, because it gives you an idea as to how you're tracking, and you can start to be, I guess, hone in or narrow down, the particular properties that are actually applicable and relevant to you, and just give you that greater sense of clarity.
It also gives you a bit of an insight into what the repayments might be.
Yeah.
Because I have conversations with people all the time. They go, my friend bought this house and we want to do the same. Then we tell them what the weekly repayments would be, and they'll fall off the chair and they say, okay, well, we can't afford that.
Yeah.
So you need to know where you sit. And
that just might mean not trying, but just reassessing and just maybe bringing that expectation down to something that does fit within your budget, or even they might be able to afford it, but their lifestyle is a bigger priority and they're not prepared to, dedicate that much money out of their cash flow to a mortgage.
Correct. And I think the biggest side of what the government's trying to do here is to promote and encourage as many Australians as possible to be homeowners. Sets us up for retirement. So if that means you start, not the ideal home, it's not your forever home, that's okay. You're in the market, because one thing that will happen from this scheme is that property prices are going up.
Okay, we're going to talk about the elephant in the room in just one moment. We'll come to that. And I want the Adam to unleash and tell me his true thoughts and feelings. Okay, good. Because normally you're very politically correct and polite and considerate. I want to hear your thoughts. But my next question before you do that is, for people who are doing this or about to do this, once you've established your foot in the property market, you're in your home using the, this 5% government guarantee, how do we make sure that we can stay in that home, we can pay it off, and we can actually build our wealth beyond the limitations of a principal place of residence? Like, do you recommend not just following the bank's prescription of a mortgage repayment, but actually try and pay extra off, or use your tax refunds to pay it off, or increase your mortgage repayments with pay rises and promotions? Use the equity to look at a debt recycling strategy further down the track. Sorry, I'm starting to answer your question, but I want to make sure people realize this isn't about just getting a foot in the door. It's about building a sustainably, financially friendly life from this opportunity.
Look, I say this all the time, whether you're an existing homeowner or new potential homeowner, budget. Do it every 6 months at least. Keep on top of it. That's how you promote or increase cash flow surplus, and that's how you can pay your loan off quicker or do some investing. Obviously, you want to stay on top of your interest rate. That's what a good broker will do for you.
Yeah. And you automatically check all of your clients'
We do.
interest rates on a regular basis.
We do.
And ask for discounts on their behalf.
Yes, we bluff. And that's all it takes. Whether it's the broker doing it for you or you calling your bank, do it. It's the same with your home and contents insurance, car insurances. If you don't ask for a better deal, you won't get one.
And loyalty tax is expensive.
Loyalty tax, correct.
Yeah. Don't leave any money on the table.
No. Yeah, that aside, it's about saving. If you get tax refunds, putting into your mortgage, pay increases.
And use that extra money. It can still be your emergency money. You can use an offset account or a redraw facility. They both work exactly the same, but they save you thousands of dollars sometimes and time.
Rate cuts, the big one. And look, sometimes I speak to clients of mine or potential customers who dislike this, but when the majority of banks and lenders out there at the moment, when rate cuts are passed on, they don't automatically reduce your repayments. They keep it the same. So it means that you're getting ahead faster.
Yeah.
Now, while some people who might think that that's unfair because they'd rather the drop in repayments to ease the pressure, it's not a bad thing if you can keep at it. If not, call the bank. But if you can keep it the same, keep it. And if
or
you
as
can
close
increase
as possible.
Increase it. So they're the little things that you can do.
Yeah. And by doing a budget, okay, well, look, we're potentially saving $200 a month in interest, but we've obviously got a tight budget. Perhaps we increase have our mortgage repayments increased by $100 and we've got an extra $100 per month for the family budget.
Yeah.
You can find, it's not one or the other. There is a balance there. But if you can only see that by doing a budget and knowing your numbers.
That's exactly right.
Okay. What are your thoughts on this? Is this just a disaster, like waiting to happen? Are we just going to push housing prices even further away, making them even more unobtainable for so many Australians? Or do you actually see this as a solution?
I don't necessarily see it as a solution. I think we've got a real supply issue here.
Yeah.
And this is only going to make that more difficult with prices being pushed up, particularly with the level of immigration. The big one might be the timing of immigration and how long those immigrants could take to get citizenship or permanent residency visas before they can get into this. I don't know the answer to that. But the government aren't building houses like they've promised to. So this is going to cause us a bigger supply problem, which will push prices up.
Yeah.
Bottom line.
So it's like a token fake generosity that's not...
Yeah. Unintended consequences as well. Like, what will mortgage insurers do? The mortgage insurers are no longer getting all of this business. So if you don't qualify as a first home buyer, but you want to buy an investment property with mortgage insurance, they might increase the premiums massively to keep their business model afloat. Well, we don't know.
And also, the government is guaranteeing this, which ultimately means the taxpayers are guaranteeing this.
Yeah.
So many problems. If it's not managed carefully, it could become a financial parasite.
What are the flow-on effects? Like we said earlier, if you don't have certainty in no one has certainty, but if you don't have some stability in your employment and regular employment, and you go and take advantage of this, and then you've got to hand the keys back, and how many people might do that? Correct. Because the cost of living's not changing.
No. And if anything, it's going up. I mean, I read the other day, we basically have to get used to it.
Yeah.
There is no relief coming anytime soon.
So then if property prices are going up, the next generation, how hard is it going to be for them to get into the market?
Well, I'm actually going on the Today Show and I'm talking about this in detail because the average Australian is only going to pay off their home around age 59. And if people are looking at retiring at age 65, you are only leaving 6 years to quickly top up your super, which is not nearly enough. I mean, obviously it's better than nothing at all, but if 70% of your net income has gone towards a mortgage repayment, paying it off, we're going to have a generation of, yes, they'll own their home outright, assuming they haven't refinanced and they haven't moved and they've just simply followed that 30-year term with nothing else to fall back on.
Government will probably force them to sell.
Then we'll see an excess supply of properties with people having to, being forced to downsize. Look, Adam, as always, I really value your wise advice. You look after me and Tom, you look after, as I said, my family and friends. So for anyone that wants to talk to you, what's the easiest way to get in contact with you to talk about this opportunity or talking about more complicated strategies like, self-managed super fund borrowing, debt recycling strategies, or even just checking your home loan to see if it actually is a competitive rate? Like, what's the easiest way to go directly to you?
Look, email, phone is best. We've also got the website where you can book an appointment through the website.
Oh, great. And there's no charge to come and see you or speak to you?
No, we don't charge any fees on the broking side or the financial planning side, not for initial consultations. The planning side there can be, but that's a separate discussion if you're after that. But on the broking side, we never charge fees.
And you work with your in-house financial planners so that you're all singing off the same page and helping clients not just pay off their home
correct,
but also build
all
wealth.
Working and pulling in the one direction for our clients.
Yeah. Thank you so much. I will make sure that I put your contact details. Hopefully no one get any spam or prank calls, but I will make sure your details are obviously securely in the podcast notes for everyone to reach out to. And, please know that if you see Adam, speak to Adam, don't even need to mention my name. This is not sponsored in any way whatsoever. Adam is just a very trusted resource, and I have major trust issues with people. So having Adam on the show means a lot to me because there are not many people I do trust. And I've known you for 20 years now.
Thank you, Ken. I love coming on.
All right, everyone. Thank you so much for listening to today's episode. I'd love to hear what your thoughts and feelings are about this new scheme, whether you think it's going to help or hinder our economy, and whether you're actually going to take it up yourself or whether you have friends that will take it up. I'd love to hear your feedback. So send me a DM on Instagram. Let me know what you think of this episode. And of course, what other questions you might have for me or actually even for Adam. How would you like me to pick Adam's brain for the next Ask Adam episode? In the meantime, have a brilliant week. And I look forward to checking and touching base with you at the end of the week for Start Here, the special mini-series within Sugar Mama's Fireplay, where I get to answer your burning questions about your financial goals and dreams. All right, have a brilliant week. Connect again on Friday. Ciao for now.